We're heading into a recession. Of that, I'm absolutely certain. The supply and demand is basically bypassing the market. And instead, we've got a market which is a paper market. And a paper market is essentially an emotional market. I mean, it's just absolutely amazing. You can see they do this sort of pump and dump operation time after time after time. And it's been the way the whole system has worked, I think, for the last 20, 30 years. The reason I say this is that I want to just impress on everybody that this market is actually not a real market. It is a speculator's market. And the underlying stuff, the hard stuff, the bullion which we think it represents, actually doesn't go through the market.
In a recent interview with Alasdair MacLeod, former bank director and head of research at goldmoney, he raised awareness over the stagnation of the economy, attributing any purported GDP growth to non-productive government spending rather than genuine economic expansion. MacLeod delved into the intricate dynamics of the gold market, underscoring its speculative nature despite hedge funds consistently incurring losses. The discussion extended to the U.S. debt scenario, with MacLeod challenging official figures and urging a closer look at tangible economic indicators, such as the beleaguered trucking industry and logistical challenges. Geopolitical factors, including Russia's perceived advantage in the Ukraine conflict and China's discrete gold accumulation, were emphasized as drivers for the increasing importance of physical gold as a hedge. Alasdair also expressed apprehensions about the banking system, citing recent failures and hinting at unconventional measures by central banks to avert a potential crisis. Like, subscribe, and turn on notifications for more videos like this, and check our pinned comment if you want to add crypto exposure to your portfolio, so you get the best sign-up bonuses available in the market. Let's get into the video.
This is important in the context of oil prices, the outlook for inflation, the outlook for interest rates, and therefore the outlook for gold. But technically, the gold is looking actually very interesting because having challenged the 2000 level, which didn't suit the bullion banks, let's face it, and the bullion banks saw open interest on COMEX rising, presumably in the far larger market, which is the London bullion market. They will also have seen the same sort of characteristics of speculators getting into the market, buying forward contracts, and and I mean, the thing is, you can sort of feel the quality of the speculators, and when they're very poor quality, which I think has increasingly been the case, then you can bang the price, and that's what they've done. And so it saved that 2000 level. But we then had a slight change, and the initial thought about the slight change was interest rates don't have to go up very much more because it looks like things are improving, whatever the story. We saw the 10-year US Treasury back off from the 5%. Go back down to 4.5%. Oh, that's immensely bullish. The whole system is going to be all right, so sell gold. That was the initial reaction, which is interesting because for the last 20 years, everybody's been telling us when interest rates rise, that's bad for gold. When interest rates fall, it's good for gold. But gold fell with interest rates, with bond yields, if you like. But then there came a point where we bounced. So it just shows how the technical moves you're seeing in the market actually got nothing to do with, what we're being told by so-called experts in the market and all the rest of it. And I think that the technical position in the market now looks very, very good because having just backed off from that 2000 level for what? I don't know, fourth, fifth, sixth time, I think it's ready to really go through. And if you look at the moving averages in the chart underneath it, they are moving up in bullish sequence. They underwrite the price around about 1920, 1910, something like that. We didn't actually get down to there. I think we got down to, 1930 or something. So you can see that the number of things are coming right. Now, we need to look, I think, at the fundamentals as well. And that is, if you just look at the situation with the debt trap, that there is absolutely no doubt America cannot escape. And America is important because the dollar is the currency which every other currency is tied to. They refer to the dollar. If you weaken against the dollar, you have to raise your interest rates. And if you want proof of that, just look what happened to the yen. I mean, they've still got negative rates in Japan. They're desperately trying to suppress bond yields. And the yen has collapsed. It's gone from 110 down to 151, something like that. I mean, this is something like a 40% collapse in not a lot of time. Why? Because they have resisted the rise in interest rates. So everybody else has to raise their interest rates in order to keep.
Gold prices inched up on Friday, showing promise for a strong weekly performance amidst growing speculation that the Federal Reserve might hit the brakes on interest rate hikes, fueled by a series of lackluster U.S. economic indicators. Experiencing its most robust week since early October, gold maintained proximity to the coveted 2,000 per ounce level, rebounding from a recent sharp downturn. The uptick was reflected in a 0.2% rise in spot gold to $1,985.60 per ounce, with gold futures registering a slight increase to 20 yet 5 per ounce abagag o 6 AET, 5 euro 6 GMT. This upward trajectory translated into a noteworthy 12.5% to 3% weekly gain, driven by softer-than-anticipated inflation data, prompting expectations of a decisive Fed hiatus. Gold also found support as safe haven demand surged in response to concerning economic reports from Japan and the Eurozone, reigniting fears of an impending global recession. This week emerged as a pivotal day for the yellow metal, as data unveiled a fourth consecutive week of higher-than-expected U.S. jobless claims, indicating a further cooling of the labor market. Gold prices jumped over 1% in the aftermath of this revelation, given the significance of a cooling labor market and subdued inflation as critical factors influencing the Fed's decision to halt its rate hike cycle. The market witnessed a subsequent decline in the dollar and Treasury yields following the release of the data. Despite this positive momentum, traders remained cautious about aggressive bids on gold, especially with a flurry of Fed officials scheduled to speak on Friday. The upcoming release of the Fed's October meeting minutes next week is anticipated to provide additional insights into the central bank's stance on interest rates. Nevertheless, the underlying sentiment suggested that even in the event of a Fed pause, the central bank had consistently signaled its intention to sustain prolonged rate hikes, a scenario potentially detrimental to gold due to increased opportunity costs associated with investing in bullion. Shifting focus to the broader economic landscape, the report also touched upon the performance of copper prices, which exhibited lateral movement on Friday but were on track for their most substantial weekly gain in over 4 months. Now we'll show you clips of Alasdair. But first, like, subscribe, and turn on notifications for more videos like this, and check our pinned comment if you want to add crypto exposure to your portfolio, as Bybit gives you $20 just for creating an account, so you can start trading real crypto and test the platform for free.
And the idea that that actually reflects supply and demand is totally wrong. It doesn't, because the supply and demand is basically bypassing the market. And instead, we've got a market which is a paper market. And a paper market is essentially an emotional market. And on the one side, you've got the bullion banks who understand the emotions in the market. And you have got hedge funds on the other side who are the emotions in the market, as it were. So, they are the speculators, while, the guys with their heads screwed on are the bullion banks. And I mean, it's just absolutely amazing. You can see they do this sort of pump and dump operation time after time after time. And it's been the way the whole system has worked, I think, for the last 20, 30 years. Having said that, from 2020, we rose from a low, or 2022, I think, round about then, a low of around about $250 to the current level, challenging $2,000. So, even though you've had this sort of continual pump and dump operation with Hedge funds, I mean, continually losing money. Why on earth they play this market? It defies logic. But anyway, they come back for more and more, rather like gamblers at the table. They always think that next time we're going to really clean up, but what happens? They fall for it again. The reason I say this is that I want to just impress on everybody that this market is actually not a real market. It is a speculator's market. And the underlying stuff, the hard stuff, the bullion which we think it represents, actually doesn't go through the market.
Now, Alasdair talks his insights about the current debt situation in America.
Who is going to buy all the government debt that is due to be rolled over and new debt issued in the current fiscal year, which only started at the beginning of last month? We're looking at 7.6 trillion of debt being rolled over. We're looking at, well, I think that the budget deficit this year could well be well in excess of 3.5 trillion. What makes me say that? Well, first of all, last year it was nearly $1 trillion of interest cost was in that debt. They also fiddled the figures. The figures came out at about 1.7 trillion deficit, but actually that included an adding back of $300 billion, which they had originally allocated for paying off students' loans, but then the courts turned that down. So what do? It was never drawn down. They just add it back into the figures. So they reduced the level from 2 trillion down to 1.7. I mean, this is the magic of government accounting. So actually, the deficit was 2 trillion, of which 48% was debt interest. So what's the debt interest going to be this time round? Well, we can see this 7.6 trillion is going to be refinanced at higher rates. You have got whatever the budget deficit works out at. So you're looking at something like up to 11 trillion has got to be financed at current rates. Compare that with what the average debt interest was in the last fiscal year, and you were looking at 2.7%. Now we have short-term rates over 5%, and the yield curve's a bit negative. So, but you're still paying 4.5% going out along the yield curve. There's no way that you were going to see debt interest, I think, much below 1.5 trillion.
What do you think of today's show? Do you think gold and silver prices will have a meteoric rise in 2024? Post in the comments section down below your honest opinion on today's episode, and if you agree or not with Alasdair. Like, subscribe, and turn on notifications, as everything helps with the algorithm, so we're motivated to bring you more videos like this, featuring top financial experts. And I see you next time.